As Yogi Berra would say, it's deja vu all over again. The stock market is down, the economic views are depressing, and investors are anxious. Hi, I'm Richard Reyes, the financial quarterback and wealth coach at Wealth and Business Planning Group. And I want to talk to you for a few minutes about why I am not worried about the markets and why you shouldn't be concerned either. As my client, you know that we have had many conversations about diversification and investment philosophy in the past, and I understand if dramatic drops do make you a little bit queasy. Now, let's begin to review where we are today. For the last half of 2007 and continuing this year, the stock market has declined sharply. Pundits are talking about the possibility of a recession and how the government and the Federal Reserve will try to stimulate the economy and turn things around. So as our client, you may be asking yourself what the educated investor is to do to cope with this period. What I want to provide to you is a different perspective on market declines and why these corrections provide you with higher equity returns in the long term. Now, what I want to tell you is this. This is nothing new. This is called market volatility. Over the last 40 years, there have been 8 market declines of greater than 20%, about once every 5 years. Second, you don't need to be afraid of them. Think of it as a weeding out process where the short-term investors eventually bail out and put their money in fixed income. They, of course, will be late getting back into the market. This is what's called, again, market volatility, and it is your friend. Despite the 8 significant market declines, the annualized return of the S&P 500 since 1967 is over 11% a year. The reason why stocks provide such high returns as opposed to fixed income investments is because of this volatility risk. If stock markets were more stable, then your returns would be a lot lower. So market prices are random and unpredictable. No one, and please I will tell you, no one, no financial planner, no economist, no market expert or guru knows where the next 20% move will be. But the next 100% move is always up. As a client invested in our free market prudent portfolios, your portfolio is diversified in over 10,000 companies in 39 countries, as well as over 14 different asset classes. Hardly anyone else is invested in this same manner. To lose everything would take a global extinction level event. The right thing to do now is just to remain disciplined. That is why you pay me for, to be your coach and carry you through these scary times. And we have already prepared for this. I know that when you are in it, it feels like it'll never end. But it will. This too shall pass. If I encourage you to sell your prudent portfolio, it will destroy your long-term potential of success. This is what the other brokers and other financial planners want to do so that they can earn additional commissions and increase the profits of their company but destroy yours. Remember, you wouldn't sell your house just because housing prices are down. Neither will you do this to your portfolio. Stocks are long-term investments, and these fluctuations are absolutely meaningless. Now let me give you a to-do list. Number 1, I just want you to turn off the hype. Okay, this is what we call the financial pornography. Turn off the TV or switch the channel and don't read the newspaper or magazines. Number 2, I want you to focus on the long-term goals and plan that we have set for and made for you. Number 3 is that you as a client must attend our quarterly investor education series. Of course, it's my responsibility to let you know exactly the dates that they will be held every quarter. Number 4 is if you have questions, just go ahead and call me. And number 5 is trust the process. As your coach and financial quarterback, my to-do list is not to panic, not to market time and move your portfolio from cash to income to stocks. That is not our job. That is not a financial planner's job. But my job is to coach and educate you about the truth of investing and again, take you through the process. Okay, now let me tell you a quick story that relates to this idea of seeing beyond the current market environment. At the latter part of last year, I got the flu really bad, and I was in bed for a while. I called the doctor and asked for an appointment. However, they would not give me an appointment for at least 7 days, and he would not even prescribe a prescription. His advice was to wait at least 7 days before he would see me, and this would give the body time to fight the cold. So I rested, sat around the house, but I always knew that despite feeling awful, it would always get better. I knew it may take a week. Hey, it might take several weeks, but I never had any doubt that things would improve. This analogy is similar to the current market illness. Things today may not be going the way you hoped, but we know that markets recover. Maybe next week, maybe next month, or later on this year or next. But we know from decades of experience that markets don't stay down because companies find ways to grow, increase profits, and then their prices increase. So my advice is to ignore today's market. Appreciate the important things in life and take the long view, because things will get better for those who stay the course. Thank you.